Hello, welcome to Accounting with Arpit Garg, Part 4 of Fundamentals of Partnership. I hope you have gone through our previous videos. If not, the link is given in the description box. I recommend you to go and watch that to clear your basics. Now, as we know, we were studying accounts of partnership firm, and there we studied our first two topics. So today we are going to start our next three topics: interest on drawing, partners remuneration, and transfer to reserve. Drawings. Remember what is drawing? Yes, amount withdrawn by owner from business for his personal use is drawing. Now here we have drawings of two types: drawing against profit and drawing against capital. Now what does this means? Drawing against profit means withdrawal by a partner out of his profit, which means whatever amount he will earn from business and he takes that amount to home to maintain his household expense, or for the profit only we all work, so we need money for our life, for our livelihood, for our expenses. So for that, when we are taking money from the business, that is drawing against profit. But what happened is, one day I felt that, or we partners felt that we all have introduced rupees 5 lakh in our business, and we are total 3 partners. So our total capital is rupees 15 lakh. But now we think that this business can run smoothly in rupees 12 lakh also. So we all withdrew rupees 1 lakh each from the business. This withdrawal of rupees 1 lakh will reduce the capital. So here it is drawing against capital. Next, drawing against profit is debited through drawings account, but drawing against capital, as it is reducing our capital, will be debited to capital account. Then it is part of profit and another one is part of capital. Drawing against profit does not reduce capital. Drawing against capital reduce capital. Now, most important ones for our calculation part. While doing drawing against profit, if we have done drawing against profit, calculation of interest on drawing will get affected, because it is a part of drawings. You can see in second line. But in drawing against capital, it is not considered while calculating interest on drawing, because you see in second line, drawing account is not at all affected. Now next, for calculating interest on capital, drawing against profit is not considered because capital is not changed. But while calculating interest on capital in drawing against capital, it is considered because it changes the capital, as it has reduced our capital. Once again, while for calculating interest on drawing against profit will be considered, because this is drawing as we see in our second entry. But drawing against capital will not be considered, as this thing we have entered in our capital account. So drawing account is not affected. But for calculating interest on capital, it is vice versa. That for drawing against profit, it is not considered, as drawing account is affected but capital is not affected. But while calculating from drawing against capital, it is considered because capital amount is changed, it is reduced, so it is considered. Next, please note, interest is neither charged nor allowed on drawing against capital. It is interest on drawing. Interest on drawing is neither charged nor allowed on drawing against capital. And for drawing against profit, we have to see this. Then let's see how interest on drawing is calculated. So we have three methods of calculating interest on drawing: simple method, product method, and average period method. Now let's read when these methods are used. So if we have withdrawn unequal amounts, which means one day I withdrew rupees 10,000, another day 15,000, another day 20,000, then 1,000. So unequal amounts and different dates, on 1st April, then 15th April, then 3rd May, then 19th September. You see, different dates are there. So in both these methods we will use simple method or product method. But if our amounts are equal and we have uniform time interval, for example, a partner withdrew rupees 10,000 on first day of every month or on 10th day of every month. So amounts are equal and time is also equal. So there we will follow average period method. Let's solve a question of simple method to understand the concept. Please pause the video, write the question and make this format also. Done? Let's begin. In a partnership, partners are charged interest on drawing at the rate 15% per annum. During the year ended 31st March 2019, a partner drew as follows. Dates are given to us, amounts are given to us. What is the amount of interest chargeable from the partner? Let's calculate. First, dates are given, so I will write here dates and then my amounts. Now, look for the last day of the year. Can you see? The last day of the year is 31st March 2019. So, in terms of months, remember, in terms of months, calculate the time between date of drawing and last day of the year. That is number of months up to 31st March 2019. So you can calculate from 1st May to 31st March, 11 months. Then 1st August to 31st March, 8 months. 30th September to 31st March, 6 months. 31st January to 31st March, 2 months. 31st March to 31st March, 0 months. Then let's calculate interest according to these. So 20,000 into 15% into 11 by 12, as it is per annum, so we will convert these months into year by dividing by 12. Then 50,000 into 15% into 8 by 12, 20,000 into 15% into 6 by 12, 60,000 into 15% into 2 by 12, 20,000, no need to calculate, as we multiply any number with 0, we will get 0 only. On adding all the interest amount, we get our total interest as rupees 10750, 10,750 rupees. Now let's solve same question with product method. So the question is same, you need not write it again, but please make this format once again. Now the change is, here we will calculate our product, which means we will multiply the amount with number of months. So we will get 20,000 into 11, 50,000 into 8, 20,000 into 6, 60,000 into 2 and 20,000 into 0. Then we will add this amount, 8,60,000. Then calculate interest on drawing. So here formula is total drawings or we can say total product here, that is 8,60,000 into rate of interest 15% per annum into time. Calculated these according to months and we have multiplied, so here time will be 1 by 12. We will get answer 10,750. It's same as we got in simple method. Then let's look what's average period method. As we know, here amount of drawings are equal and there is equal time interval. First let's look our formula. So interest on drawing is equals to total drawings into rate of interest upon 100 into average period divided by 12. So here we need not calculate interest separately for each drawing, or we need not find product of every drawing like we did in last two methods. So let's see how in average period is calculated. First is if we have drawn month wise. So these are all months written here. Now if drawing is made in the beginning of every month, it means on the first day of every month. So 1st April, 1st May, 1st June, 1st July and so on till 1st March. So here you can do two things. First, either learn all the numbers of every drawing, or you can understand the concept of how you can calculate this very easily yourself. Let's see how calculation is done. So find out the date of your first drawing, as it is done in the beginning of every month. So first drawing is made is on 1st April. Then find out when was our last drawing made. It is on 1st March, that is beginning of last month. Then find last day of the year, that is 31st March. See, first drawing, then last drawing and then last date of the year. Then calculate time from April 1st to 31st March, that is 12 months. Then March 1st to 31st March, that is 1 month. Then simple, 12 plus 1 divided by 2. We will get 13 upon 2 or 6.5. I recommend you to use 13 upon 2, that is 13 upon 2 into 1 by 12, because if you use 6.5 you will get 65 upon 120, so that is difficult for you to calculate. Not understood? No problem. In next method let's try. Now when drawings are made at the end of every month, let's see, first drawing is made on 30th April, that is last day of month. Last drawing will be made in last month, so 31st March. Then last day of the year, March 31st. Then time from first drawing to last date, 11 months. Time from last drawing to last date, 0 months. Simple, 11 plus 0 divided by 2. Next, if drawings are made in the middle of every month, let's look. First drawing will be in the middle of first month, April 15. Last drawing, March 15. Last date, March 31st. Then 11.5, 0.5, it is time between those. Then 11.5 plus 0.5 divided by 2. It comes 12 upon 2. That is 6 months. Done? Now let's look when drawings are made quarterly. You know what is quarter? Yes, it's 1/4. And we know that we have 12 months in an year. So on dividing 12 by 4, we get 3. So every quarter has 3 months. First, April, May, June. Second, July, August, September. Third, October, November, December. Fourth, January, February, March. Now let's calculate when drawings are made in the beginning of every quarter. So first drawing will be made on 1st April, then 1st July, 1st October and 1st January. So our last drawing will be on 1st January. Then last date of the year 31st March. Then time from first drawing to last date 12 months. Last drawing to last date 3 months. Then 12 plus 3 divided by 2, 15 by 2. Then if drawings are made at the end of every quarter, so first drawing on 30th June, last drawing on 31st March, last date 31st March, time from first drawing to last drawing 9 months, last to last 0, 9 plus 0 divided by 2, that is 9 upon 2. Then if drawings are made in the middle of every quarter, so here just look at the middle months, that is May, August, November and February, and in middle of those months also, middle of those quarter or middle of those months also, 15th May. So first drawing will be made on May 15, then last drawing on February 15, last date March 31st, then 10.5 months, 1.5 month, 10.5 plus 1.5 divided by 2, that is 6 months. Now let's move very quickly if we do not draw this diagram. So when drawings are made during 6 months, so let's try to make this calculation quickly. If drawings are made in the beginning of every month, so as we are having only 6 months, so first drawing will be made on first date of first month. So from first date we have 6 months. Then from last month, from first date to last date, it is 1 month, like 1st March to 31st March, 1 month. So here it is 6 plus 1 divided by 2. Let's understand in second one, if drawings are made at the end of every month. Remember we have only 6 months. First drawing will be made at the end of first month. So 6 minus 1 month which is gone, 5. Last drawing will be made on the last day of last month. So it will come 0. Then 5 plus 0 divided by 2. Then middle of every month. So first drawing will be made in the middle of first month. So first 15 days are gone. So we will have 5.5 months left. Last drawing will be made in the middle of last month. So we will have only 15 days left. So that is half month, 0.5. So we can say 5.5 plus 0.5 divided by 2. Now, in all these cases, time was given to us. But what if time is not given in question? Let's see if date of withdrawal is not given. So here we will take our average period as 6 months. Now once again let's look our formula of calculating interest on drawing. First we will calculate total drawings. For example, in the beginning of every month, rupees 1000 is withdrawn. So it is 1000 into 12, or 1000 is withdrawn in the middle of every quarter. So 1000 into 4. So total drawing into rate of interest upon 100 into average period divided by 12. Then let's look at general entries to record these transactions. As we know, interest on drawing is our income. Why? Because partner is taking money from us. Remember, we are firm. Partner has given us capital. Now he is taking the amount back. So he is taking drawing from us. When he is taking drawing, he will give us interest. And when we are receiving, so it is our income. And all incomes and gains are credited. So credit interest on drawing account and debit partner's capital or current account. Then closing entry, debit interest on drawing and credit profit and loss appropriation account. Now next topic, partners remuneration. So here first look the calculation of commission, and this we have studied in 11th class also. That is percentage of net profit before charging commission. So net profit before commission into rate divided by 100. And if it says percentage of net profit after charging commission, then net profit into rate divided by 100 plus rate. Now as we know, remuneration we are paying to partner. So it is our expense. All expenses and losses are debited. So partner's salary or partner's commission account debit to partner's current or capital account depending upon fixed or fluctuating capital. Then profit and loss appropriation account debit to partner's salary or commission account. Then our last topic of today, transfer to reserve. Calculation will be given in question. We can calculate using that percentage. The entry is profit and loss appropriation account debit to reserve. You can remember by the way that reserve is part of profit and profit has credit balance. So we will credit reserve, then debit profit and loss appropriation account. That's it for today. Please solve as many questions as you can. Please take the questions from any source from where you can get. Thank you. This is Accounting with Arpit Garg signing off. Bye bye. Take care. Stay safe. Keep learning. Jai Hind.